end to QT. There's, of course, the Pringles can, and not a whole lot at the press conference to explain everything other than Jay Powell trying his best to play both sides. Now, the headline that caught everyone's attention, certainly the market's attention, was that Jay said the December rate cut is not a foregone conclusion, when what was clearly a nod to the hawkish faction on his committee, because now we have a hawkish dissenter, Kansas City's Jeffrey Smid. As far as the QT goes, the Fed said they're going to end QT December 1st for really a nonsensical explanation, which means that Mr. Van Meter was actually correct once again. He nailed it as far as the Fed is concerned, that the Fed is not going to be, they don't want to be pressured into doing too much all at the same time. They can't cut rates and at the same time cut QT, because that would look a little bit too suspicious. Though Powell did, as I'll get to in a little bit here, Powell did admit that the volatility in money markets, he chose his words very carefully, but the volatility in money markets did accelerate the Federal Reserve's timeline for ending its balance sheet runoff. And given where the money markets are today, which we have to get into here, especially what happened in afternoon repo, we can understand why, which suggests that there may be an even more accelerated timeline that the Fed is not anticipating, especially with rates starting to rise and repo facility usage. But let's go over where we are here with the Fed and everything that just went out, everything that just happened a couple minutes ago, or a couple hours ago here. Give me just a second. All right. So the biggest thing you can kind of see in the background there was the Fed's, we started out today with about $10 billion being borrowed from the Fed's repo facility, which is the most yet outside of a quarter end, $8 billion on mortgage-backed securities, $2 billion on treasuries. But then later on in the afternoon, there was about $76 million borrowed in the afternoon repo, which we have not seen yet. So on a perfect day for escalation. As far as the Federal Reserve itself and what was just announced, the Pringles can was back open. They lowered the federal funds range by a quarter point down to 3.75% at the lower bound and 4% at the upper bound. And they also said that they're going to conclude the reduction of aggregate securities holdings, which is QT, balance sheet runoff, on December 1st. And Powell didn't get really a whole lot of questions on balance sheet runoff and QT, largely because, first of all, the Fed really does not want to talk about this. Again, Steve is right about that. But more importantly, nobody in the media really knows what it is. So they don't really have any good questions to ask to begin with. So the Fed didn't really get a lot of questions, or Jay Powell didn't get a lot of questions on the balance sheet runoff. There was a couple dissenters, not one we all knew, Stephen Marin, who said, I want a half a basis point rate cut, which is exactly what he said in September when he was first seated at the FOMC. But now we have a hawkish dissenter, Kansas City's Jeffrey Smid, who did not want any change. And it just goes to show that the committee has no consensus about where the economy is, nor the economic risks. And that's one reason why Powell came off, almost two-sided, because he really was two-sided. He has to placate both factions on the committee. So now we've got dissenters, which the market picked up as slightly hawkish to go along with the main takeaway, the headline that splashed across all the mainstream media this afternoon. Powell said that the December rate cut, which markets have been penciling in as a done deal because they are a done deal, Powell kind of tried to walk that back a little bit. He didn't go as far as he did last September, where there was the rate cut regret after the 50 basis point rate cut in September 2024. But he did make it. In his opening remarks, he said, December is not a foregone conclusion. We still don't have enough data. We don't have enough evidence either way whether or not tariff inflation is taking off. This is Powell's word, not reality. Nor do we, as we said, most of the discussion at the press conference was about the conditions in the labor market, which Powell admitted we don't have government statistics, though he did say if something big was happening, we would probably know it. We wouldn't need necessarily the Bureau of Labor Statistics to come along and tell us something big is happening. But either way, they said, we're watching developments. We can see downside risks, but there is a part of the committee, as he said, that said maybe these downside risks to the labor market, maybe they're not really risks at all. Maybe this is sort of a mirage. The idea here is that the tariff inflationists on the committee they're not necessarily convinced that all the labor market weakness that we've gotten, the data that we have up to this point, actually means anything beyond strictly that, okay, maybe the labor market has cooled off and maybe there's some benign reasons for it. So there are those on the committee who are still more worried about inflation, and therefore, if they don't see any confirmation of immediate danger that jobs are about to be lost in massive ways, apart from Amazon, of course, then they would prefer to take a more cautious approach because they're still not convinced that tariff inflation isn't actually breaking out. As Powell said, there is some increase in goods costs, certainly not services, according to the last CPIs I went over recently. But there are some increases in goods costs that suggest to some committee members they should take a more cautious approach because the labor market weakness that the rest of us are talking about, they don't necessarily believe that it is meaningful. And so that's why Powell came off and said that December is not a foregone conclusion because the tariff inflationists on the committee, which Powell may be partly in that camp, are not yet convinced that there is any downside risk to the economy beyond what we've seen so far this summer in jobs and employment. And as far as the repo and QT and everything else, he said the reason why they're waiting until December 1st, this is the Fed's explanation, is that I love this quote because it's completely made up and meaningless. It gives the markets a little bit of time to adapt. Adapt to what? If the Fed's bank reserves and the level of bank reserves are causing a market tightness, what do they need to adapt to? More market tightness is going to continue to happen throughout the rest of October, a couple days left, and into November? It makes no sense. And the Fed, and this is where Steve is absolutely right, the Fed does not want to be seen doing too much because there's too many people on the committee who don't believe the Fed should be doing anything to begin with. And so Powell, as the chair, is kind of stuck in between trying to play both sides. On the one hand, yes, labor market weakness is apparent, though it isn't apparent about what that actually means for the wider economy. And on the other hand, the repo mess and money market tightness is also apparent, but there isn't any conclusive, definitive evidence that suggests what that also means. So he's trying to say, look, we see everything that's going on, but we are not making any concrete determinations. You're basically trying to wash their hands of everything and saying until something absolutely breaks decisively in one direction or the other, whether it's inflation or the jobs market or the repo market, the Fed just prefers to do nothing, which, by the way, is the opposite of what we're supposed to believe the Fed actually does, or any central bank. They're supposed to be proactive. They're supposed to say, hey, we know what's going on. We have our finger on the pulse of both the monetary system as well as the overall economy. We have a great handle on how things are standing. And if things are moving in the wrong direction, we have all the tools to fix it. That's not what the Fed does. This data dependence from the Federal Reserve these days is something completely different. Now it is, we have no idea what's happening, and we need data to come up and tell us what is happening because we don't have any other idea. We don't have any idea otherwise. And when we finally get some statistics, then we have to have conclusive numbers that show us for sure, without any shred of a doubt, that this is what's taking place. The Fed is completely backwards and blind because of everything. Because of the fact that they have no idea what's happening in either the economy or the money marketplace at this point in time, which is, again, the opposite of what the Fed's supposed to be. And as far as these committee members who don't believe that the labor market weakness is anything that's meaningful yet, well, American consumers and workers beg to differ, and they beg strongly to differ, and they beg increasingly strongly to differ. I talked about yesterday the consumer conference numbers from the Conference Board. It wasn't just the conference numbers of the index. It's everything that we keep hearing from workers themselves who say, we don't like where things are going. To the point that as far as the Conference Board's numbers were concerned, they say that Christmas spending this year is on pace to be down about 4% in nominal terms, which is enormous. And that wasn't even the worst part of it. Consumers are going to spend 12% less on non-gifts just so that they can fit in what little Christmas shopping they're going to be able to do. That doesn't sound like some kind of maybe sort of problem with the labor market. That sounds like consumers are actually feeling the pressures here and and if they're not acting on it now, they are preparing to act on it over the next couple of months. So the Hawkish committee members are not convinced there's anything meaningfully bad or downside in the labor market when the evidence keeps piling up that there is. So while Jay Powell had to say that the December rate cut was not a foregone conclusion, that is Jay Powell as a politician, not as an actual economist. Not that there's a lot of economics being practiced at the committee anyway. So while they won't commit to a December rate cut, they're being forced into the Pringles can like always by both the labor market conditions and the overall weakness in the economy, and as well the mess that's going on in the money markets right now. And it's not, I mean, let's be honest here. It's not a huge mess. We're not talking about, crisis level proportions, but we shouldn't be seeing anything at this moment in time. the repo facility should be seeing zero usage, let alone, a heavy morning usage and then a little bit in the afternoon. We shouldn't be seeing anything. And the fact that we are suggests that while these are not crisis proportions, they are significant enough to pay attention to, because it suggests that there is volatility and meaningful tightness taking place around the outside, around the edges, as these things always begin. You get a little bit of tightness over here and a little bit over here. And if nothing changes, it gets a little bit bigger and a little bit bigger, not in a linear process, but in a discontinuous process, which is one reason why the Fed decided they're going to end QT. And by ending QT, it really doesn't do anything. But let's talk about where we are today. Let's talk about where we are yesterday, because the Fed doesn't give us the SOFR rate until tomorrow. So today's SOFR rate won't be known tomorrow, and I guarantee it'll be more than 4.31%. But the SOFR rate from yesterday, 4.31%, is 6 basis points above the current upper limit for the federal funds range. And as I have to explain here, the Fed does not target the repo rates or anything with repo. What instead happens is the Fed realizes that if there is tightness in repo markets, as we're seeing here, that has the potential to spill over into federal funds, which the Fed does target. And so if there's a mess in repo that gets to be bad enough, it becomes a volatile mess in federal funds. That is something the Federal Reserve has pledged to do something about. So they have a vested interest in watching what's happening in repo markets and trying to tamp down on volatility and supply funds where necessary in order to keep those money markets in relatively orderly fashion so that it doesn't become a problem in federal funds, which obligates the Federal Reserve to respond. And what the Federal Reserve is actually saying is that it doesn't matter at this point. We see some volatility in repo markets, but it's not actually something that we're going to worry too much about, at least at this point. That's what they're saying in public. They don't want to make too big of a deal out of it. So the $7.75 billion borrowed from the Fed repo facility yesterday. And notice, by the way, the repo facility is supposed to help keep a lid on repo rates, and yet there's borrowing at the repo facility that is not keeping a lid on the SOFR rate. Now the SOFR rate is 6 basis points above federal funds. It'll be even higher above federal funds today because there was $10 billion borrowed from the morning repo facility, and then an additional $76 million in the afternoon repo. Just at the end of June, the Fed decided to do both a morning and afternoon repo. This is the first time we've seen afternoon repo during this latest bout of illiquidity in the marketplace and tightness in money markets. So now instead of $7.75 billion yesterday on MBS collateral, now we've got $8.2 billion on MBS collateral in the morning, another $2 billion on Treasury collateral, and then $76 million on top in the afternoon. Again, the monetary tightness is escalating relatively quickly here. So while it doesn't denote the end of the world, this is not 2008 rerun, it is instead significant tightness in the money markets. And so the question is where it's coming from and what to do about it. Well, the Fed says they're going to end QT and that should take care of everything, when this doesn't look to be about bank reserves. In fact, it's never about bank reserves, but that's the only policy the Fed has that could potentially have, at least in theory or mainstream theory, that could potentially have any impact on the marketplace. And you can see what I mean about escalation. It started back in the middle of September, and the Fed says, well, that's just balance sheet runoff. It's a level of bank reserves that's fallen below $3 trillion, and $3 trillion is somehow some magic number. And so the escalation in repo borrowings is just the marketplace trying to go back to the Fed to get some reserves in temporary open market operations that it wasn't able to get otherwise because the Fed has been taking reserves away in systemic fashion through quantitative tightening. That's what balance sheet runoff actually is. The Fed lets some of its assets retire, and then it does not reinvest the same amount of proceeds, which has the effect of reducing the level of bank reserves that are available to the system. And so that's the answer that Jay Powell and economists and everybody in the mainstream media is going to give you about why we see what we're seeing here in terms of monetary tightness in repo facility borrowing, as well as repo rates that are rising, when that is clearly not the case. But as Jamie Dimon warned just a couple of weeks ago, we're seeing cockroaches show up in private credit. And the timing here seems a little bit more than just random coincidence. In fact, there's a much better correlation with the escalation in private credit markets and risk aversion that goes along with it, especially given the fears and every reason to be afraid of collateral that goes along with these private credit bankruptcies and whatnot. So there's a better correlation and a better timing and better time correlation with events in private credit markets, the discovery of more and more cockroaches, than there is any correlation with the level of the Fed's level of bank reserves. And I think this is a pretty clear one. But as I said, it's spilling over into money market rates, where you can see SOFR rates that are now above federal funds targets. In fact, yesterday it was by the most that we've seen yet. It goes back to the middle of September, which is just after Tricolor, the bankruptcy was announced. And we're actually seeing a little bit of it spill over into federal funds. And at his press conference, Powell was asked a couple of questions on QT, but you can tell they weren't really, there's really no depth and substance to the questions. They're basically, Powell give us the canned answer so that we can print it out in our news stories. But he did admit, the Fed chair did admit that recent market pressures did accelerate the Fed's timetable in terms of ending its quantitative tightening or its balance sheet runoff. So they did not want to do it at this moment, but they're being forced to do it, which I think is the biggest takeaway of the entire press conference, where Powell very quietly, sort of, in the mix of everything else, with all the other focus on labor markets and Fed dissent and inflation and everything else, the Fed did admit, he did say that, look, the stuff that's happening in the repo market did change our views on what we should be doing with our balance sheet, which is in many ways a recognition. Again, this is the only really important part of anything with the Fed. It is recognition that they can't just sit there, that this stuff that's taking place is becoming more and more meaningful, to the point that the Fed had to change its plans. And I think that's really the only major takeaway from the entire the Fed meeting today, is that they admitted, okay, what we already knew. They admitted that the money market mess is getting to be a little bit uncomfortable. It forced us to alter our timetable. It forced us to alter what we had in mind. So if things accelerate in money markets, which there's no reason to believe that they wouldn't, we might expect some additional moves from the Fed in between now and its next meeting in December. Regardless of the rate cut, the foregone conclusion or not, the Fed has a money market problem, which is what the central bank is supposed to take care of first and foremost, that is not going to be changed by the Fed slowing its balance sheet runoff to the point that it terminates a little bit over a month from now. How is that going to help money markets today, or tomorrow, actually, and the next day and the next week? When you zoom in, you can really see what I'm talking about here, especially the fact that it's not just... you can see how things have changed and when they have changed. You go back to the earlier part of this year, the repo rates, along with the federal funds rates, were about 20 basis points below the upper limit in the federal funds upper limit from the Fed's policy target. That began to change in early July, which, by the way, is not some random coincidence either. You can see the downside of the range in the SOFR rates started to disappear right after the quarter end, at the end of the second quarter. And that's really when we started to see the dollar begin to rise in exchange value. It was no longer sell America. We got the dollar reversing and moving higher against a lot of these key currencies. At the same time that SOFR rate starts to creep up a little bit, and then it creeps up a lot in the middle of August and moves higher. And ever since the middle of August, that's when we've really seen an escalation in SOFR rates upward, to the point that they're now getting to where they are. Visible volatility, and it has spilled over to a small extent into the federal funds market. You go back a couple of weeks into September, earlier October, the effective federal funds rate was about 4.08%, which is roughly where it has been, toward the bottom end of the Federal Reserve's range. And it has crept up over the last couple of weeks. This last couple of weeks, when we've seen risk aversion from all these private credit cockroaches that are showing up, the federal funds effective rate in the upper range, the upper percentiles, have moved up to the point where the effective rate as of yesterday was 4.12%. So still, not catastrophic, not anything to be overwhelmingly alarmed of, but there is some up creep in federal funds to go along with repo that is exhibiting more volatility, which makes sense because repo is where the money is actually transacted. Federal funds is basically a leftover at this point. There's really not a whole lot of people left in federal funds. There's not a whole lot of interbank borrowing on an unsecured basis. Most of it goes on in repo. But the point here is that there is some spillover showing up, some modest spillover showing up in federal funds, which again, the Fed confirmed that's why they accelerated their timeline to end QT. The idea that bank reserves are going to solve this, there's no correlation between money market tightness and the Fed's level of bank reserves. You go back to 2019, and I pointed this out a couple of times recently, and I'm going to continue to point it out. 2019, the level of bank reserves that supposedly led to the repo market dysfunction in September that year was $1.5 trillion, a little bit less than $1.5 trillion. Right now, we have just a little bit less than $3 trillion. So how can we have monetary tightness at twice the level of bank reserves as 2019, along with the fact that the standing repo facility that was created in the wake of September 2019's repo mess was supposed to stop all this to begin with. It's supposed to give money markets away and money market participants away to go bid for funding, to go bid for reserves the Fed might be taking away through its QT. So the idea that the level of bank reserves is somehow explaining the tightness in money markets it's not like the banking system doubled in size between 2019 and today, or the U.S. economy doubled in size between 2019 and today, and that the demand for bank reserves is twice as much in 2025 as it was in 2019. There are other factors, and there can only be other factors that explain what's going on in the repo market and repo market tightness, and it has everything to do with rising risk aversion, or as Jamie Dimon eloquently put it, cockroaches in private credit. So the fact that bank reserves are falling at the same time is another one of those coincidences that the Fed has made its modern policies out of, going all the way back to the 1980s, really. The idea that the Fed policy somehow explains something in the real world. And as Powell was also talking about his press conference, I didn't put the quote in here, but the method of operation that they use is simply they start reducing their balance sheet until something happens. It's not like they say ahead of time, we know exactly what the minimum level of reserves are. We know how much money, assuming that reserves are money, which they're not, but even assuming that they are, we know how much money the system actually needs to function in a way that doesn't lead to unnecessary volatility. But instead what they do is they just start running off their balance sheet, and they keep going until something breaks. And then when something breaks, they assume that, or at least they tell you that you should assume that the something breaks is correlated and caused by the balance sheet runoff getting to some magic level or magic threshold that they can't tell you ahead of time what that is. But when you actually see the level of bank reserves over the last couple of years, it's been pretty constant and stable. It has been relatively narrow range. It's been stuck in a relatively narrow range. So the idea that something substantial has changed over the last couple of months with regard to bank reserves, it just doesn't hold up to the actual evidence. But that's what the Fed is going to tell you. They're going to tell you it's all about QT and quantitative tightening because they can't tell you it's about cockroaches. They're never going to be able to admit that it's risk aversion that's growing for a variety of reasons, starting with concerns about the labor market that also relate to concerns about what's happening in private credit and the status of private credit, because private shadow banks have been, we all know that they've been stupid over the last couple of years, lending in risk, reaching for yield, volume growth, regardless of fundamentals, not dotting all the I's and crossing all the T's, just doing deals to get deals done because everybody believed that there was no downside. And so you throw some labor market weakness and some consumer anxiety into the mix, and suddenly everything looks different, to the point that we're now getting bankruptcies in private credit because liquidity providers in private credit, or liquidity providers to private credit, are getting cold feet. And they're getting cold feet for legitimate reasons, even if those reasons aren't convincing to the inflation hawks at the Federal Reserve. So Powell had to do what Powell always does. You have to realize, first and foremost, the Fed chair is a politician. And his job, first and foremost, is to project calm, which is what Ben Bernanke did absolutely well during 2008 and 2009, really 2007 through 2009. The guy was unflappable. It didn't matter what was taking place. The entire world was melting down, and he would get on TV and say, whether it's testifying in front of Congress or just making a statement, he sounded like the Fed had it covered. And to this day, a lot of people actually believe the guy. That's the Federal Reserve Chair's job. And that's exactly what Jay Powell did today. And I think he did it really well. If his job is simply to project calm, which again, Van Meter was right about that. Project calm means, yeah, we see the stuff in repo, but we're not really overly concerned about it. So we'll make some fine-tuning adjustments to our QT program, and maybe they'll take care of everything in a couple months. But we're not going to overreact to it, and we're sure as hell we're not going to make a spectacle about overreacting. And oh, by the way, we're going to cut rates by 1/4 basis points just because our rates might be a little bit restrictive, and we're going to support the labor market with just a couple of insurance cuts. That's the performance that Powell put in, and he even punctuated it by saying the December rate cut's not a foregone conclusion because we're not convinced that there's really anything to react to. Meanwhile, there is every reason to believe that the Fed is reacting to things that are taking place because those things are taking place, and they are taking place in visible fashion. So Powell did his best Ben Bernanke impersonation. I think it was his absolute best Ben Bernanke impersonation that we've seen so far out of the guy. So the Fed cuts rates, and by the way, there's more central banks rate cutting that's going on this week, or at least central bank meetings that are going on this week. The Bank of Canada earlier today, they cut rates again for the second meeting in a row by 25 basis points. They're now down to 2.25%. They're back into the Pringles can. But Tiff Macklem says this might be our last helping. Which is, again, common theme. The ECB meets tomorrow. They're probably not going to cut rates. They're going to hold there. They're going to say the same thing that Christine Lagarde's been saying all along, that Jay Powell wishes he could say today more explicitly, which is, for Lagarde and the ECB, it's Europe and the European Central Bank is in a good place. That's what the Bank of Canada's message was trying to be in saying that we're likely done with rate cuts, but we all know the Pringles can is undefeated. You can't beat the Pringles can. Once they pop, once they start cutting rates, they're never going to be able to stop. They're going to be able to pause along the way, as the Fed has proved and the Bank of Canada has already proved, but they can never actually stop the Pringles can. So there's going to be more action from the Fed. There's going to be more action from everywhere else. Let me go here. Where are we here? All right. And we're back. Give Powell credit. He did exactly what the Fed chair is supposed to do, which is basically kind of shrug his shoulders and say, there's some stuff over here, there's some stuff over here, but we're not overreacting to it because we don't see any reason to overreact to it. Meanwhile, they're actually altering their policies because of these things, which is really the important takeaway here. So we're going to continue to watch what's going on in repo markets and with repo rates. It'll be interesting to see what SOFR is at the end of today. It'll be interesting to see what happens with repo facility borrowing tomorrow and over the next couple of weeks to see if there's any more cockroaches that show up along the way and what that might do to all the money markets, the conditions that we're seeing continue to develop over the last couple of weeks, as well as maybe the potential spillover into federal funds if the federal funds rate continues to leak higher, as it has been doing over the last couple of weeks. There's a lot to watch here, even if we don't have labor market statistics that tell us exactly what's going on in terms of jobs and employment. There's more interesting and potentially worrisome developments on the monetary side right now due to all the macro stuff, which means that the monetary developments in many ways are telling us what the credit markets and the money markets think about the macroeconomic situation and macroeconomic risks moving forward. So appreciate everyone joining me here this afternoon for the FOMC meeting, end of QT, December 1st. Give Van Meter some credit.